So when I started investing, I started off as a growth investor and then I moved to becoming a dividend investor. But I have said that if I could go back in time, I'd probably start out as a dividend investor right from the start. That's not to say that my method wasn't successful, it clearly was, but I really often wonder how much better it could have been if I had started as a dividend investor right from the get-go. So let's talk about the build phase when you're starting out. So in the build phase, that's when you're putting as much money as you can afford, that you've budgeted and you've allocated to put into your investment account. And during the building phase, because you're continuously putting money in, you're building it up over time. Now that build phase could last a short amount of time, but usually it takes at least 10 years, probably closer to 15 or even more sometimes. Now it's commonly said that you should, in the build phase, use a growth strategy and then switch to an income strategy. But is that true, or is it just what people have been saying for so long that it's just accepted? Now that advice that people give, start with growth and go into dividends, it's not bad per se, but it doesn't really account for the differences in stock exchanges around the world, specifically Australia, because that's where I live. And so that's why I've changed my mind about this over the years. While I'm going to be speaking mainly about Australia here, I will be touching also on the US and other parts of the world, but mainly I'll be focusing on companies that pay dividends and are listed on the ASX. Now, growth companies in Australia are quite different to growth companies in the US and Europe. When I was starting out, I was mainly using US-based books and US-based investors. Warren Buffett was the investor that I most looked up to at that time. So a lot of my early criteria when I was determining what stocks I was going to buy was based on basically Warren Buffett's investment strategy. So I adapted what I read about his method of value investing and I adapted it to the Australian market. So I would look at the various fundamentals like return on equity, the price equity ratios. I'd look at whether the stock was over or undervalued. Research used to take so much time then. Now there was a lot of similarities between US-based companies and Australian-based companies, especially on how they reported their financials. So really adapting the criteria to the Australian market from the US market really wasn't that difficult in the beginning. But while researching different companies was quite similar, Australia exhibited quite different rates of growth in different sectors and different companies. Of course, you can look back and say, well, of course that's going to be the case. The US especially has a lot of these big global companies like Apple and Amazon and so on. So those listed on the US-based stock exchanges really are true growth companies. These are amazingly solid companies that grow over time, year on year. And by contrast, in Australia, most of the companies just simply didn't have that same trajectory. Of course, we still have companies here in Australia that do boom in stock price, but usually they aren't the same sort of types of companies that are established over the long term. It's usually they might grow quite dramatically over 1 or maybe 2 years, but they don't have that sustainability like some of the US companies have. And quite frankly, Australia just doesn't have the population or the market to sustain these high growth companies, which is why most of the companies here just don't have the same growth potential as companies in, say, the US do. But let's turn our attention back to dividends. So there's a lot of people that think that dividend investing is only really good for retirees since they need the income. They also think that dividend investing is not good for building up a portfolio in the build stage. I disagree, and I've gone over how you can use a dividend portfolio as a growth strategy by reinvesting the dividends. Now, it is known that Australia pays quite high dividend yields compared to other countries around the world. There's a lot of talk about people being wary of companies that pay high dividend yields for a variety of reasons. Mostly the arguments go that it's not sustainable over the long term to pay these high yields, or that it might be a false yield based on a falling stock price, which of course is why dividend yield isn't the only thing you look at. You also look at stability and longevity. However, you look at the reasons why Australian companies typically do pay higher dividends, it's because the growth potential of most companies isn't there. Many Australian companies just don't have the capacity to expand and innovate and grow like a lot of global companies. So there's many public European companies where it's actually really rare to find a dividend yield above 5%, and 3% is considered quite high there. But what they lack in dividend yield, they can make up for in growth. But companies here, they have to do something with their profits. And if they can't expand and innovate like some of these big global companies can, because they have to do something with the money, they give it back to shareholders as dividends. You'll see a lot of people looking at the dividend payout ratio to see how much of the dividend, of the earnings, they're paying out to shareholders. The argument being that if it's too high, it won't be sustainable over the long term. And while it is helpful to look at this, it really doesn't tell the full picture. Banks here in Australia, probably not this year though, typically pay 80%, even sometimes up to 90% payout ratios. And it is sustainable for companies like this because there's no growth potential. They have no other choice but to use that money for shareholders. I mean, they could pay their CEOs bigger wages, but we know how Aussies feel about that. So when you're looking at dividend versus growth, you really have to pay attention to the companies, the types of companies that you're investing in, and of course the country and the market that you're investing in, because there are differences. If we look at some studies and some data that's been done, it's actually really interesting to see that in a lot of cases, dividend portfolios actually outperform growth stocks over the long term. A similar US-based study that looked at stocks between 1972 and 2017, it was by Hartford Funds, and again, it showed that dividend stocks tend to outperform the S&P 500 as a whole, being the reasoning that growth stocks, or all stocks really, only experience high growth when the market is rising. When the market is falling, like it is now, you simply aren't making money unless you're receiving dividends. You could even argue that 2020 is an even better example of this, because while many companies have reduced or cut their dividends, not all of them have, especially here in Australia. Looking at an Australian study by Russell Investments, even given the COVID reduction in dividends, the high dividend ETF outperformed the market. And that's just taking into account stock price, not even taking into account the dividends that you would have received during that time. I rely on my dividends for income, for living day to day. And while my income has been reduced and lowered, it hasn't been lowered by that much, like significantly lower. Like I still have enough income to cover all of my expenses. It's really only been the financial companies here in Australia that have cut their dividends or deferred them, and they only make up about 15% of my portfolio. So my income hasn't been wiped out. I am still receiving income even this year. And if you look at the overall value of my portfolio, it's currently around the same value as it was, say, 3 years ago. But during those 3 years, the amount of money that I've received is quite substantial. If I was a growth investor, I wouldn't have anything. I would have to wait it out. And if you're building and reinvesting the dividends, again, a majority of those companies in Australia are still paying dividends. That means your portfolio is growing with all of these added shares. Currently, the market is looking way better than it did 6 months ago, but it still has a way to go. So if you're a growth investor, you're going to have to wait it out. If you're a dividend investor, depending on what stocks you own and what ETFs you own, you are still receiving dividends. You are still getting a return for your money. And if you're in Australia with those typically higher dividend payouts, if you're reinvesting, you're going to have a much stronger portfolio at the end when the market recovers. And that's why I wish I had started as a dividend investor. I feel like I would have had a much higher portfolio. But we have to be happy with our journeys and our learning experiences along the way. I hope this video has helped. Remember to do your own research and make your own financial decisions. Just because I invest a certain way doesn't mean it's the right way for you. You do you, boo. Anyway, take care, have a great weekend, and I'll see you in the next video. Bye!